Hi there, guys. Welcome to Midweek with Indiacharts. I am Muskan Kapoor and we're joined with Jay Vora. Before we start, I want to wish everybody watching a very, very happy Diwali.
Yeah, happy Diwali and happy New Year to all our viewers.
So, yes, let's just get started. Let's have a happy conversation. We will start by understanding this theoretical concept by Martin Pring, which is known as the business cycle, and how it basically helps the investors.
Right. So I have made a small presentation on it. I'll just quickly share it. So yeah, if you see, this is the business cycle by Martin Pring, okay, wherein it tells you that, this business cycle basically has 6 stages, okay, in which, at some point of time, bonds, they bottom out, then stocks bottom out, then commodities bottom out, then bonds at some point of time peaks out, stocks peaks out, and commodities peaks out. And these all happen in stages, okay. So how the business cycle by Martin Pring help us is by analyzing that stay which stage are we in. Once we know that we are in which stage, okay, it becomes very easy to understand that which asset class we have to buy and which asset class will make more money for us. Okay. So with that, I'll just start with the stage one. So in stage one, essentially the bond prices are going down, which means that the bond yields are rising higher. Okay. So in this phase, please understand that you all have to understand it with the context of bond prices and not the yields. Okay. So when bonds are going down, that means the bond prices are going down. Okay. So that might create a bit of confusion. So I wanted to clarify. So in this, there are 6 stages, as I mentioned. So the first one is when the bond prices are going down. That means the bond yields are going up. Okay. So there comes a point when the yields have gone enough higher. Okay. And that's where, it starts hitting the growth. And because it hits the growth, so at some point of time, the demand for the fresh money would come down and that will push the yields lower. So when the yield starts going down, that is the time when the bond prices will bottom out. Okay. When the bond prices bottom out, at some point of time, what happens is that because of the lower yield, again, the demand for credit will start kicking in. Okay. Because your cost of doing something goes down. So it encourages the businessmen to then take more loans and then, start expanding and all. And that what sort of leads to a trough in the stock markets, okay, which is at this stage, and this we call it as a second stage. At some point of time, when the growth pickups, the demand for the commodity starts coming up, okay, and that is the point when you will see commodities also bottoming out. Okay. So what happens is that, and this is essentially stage three. Now what happens is that the economy is doing very good. Okay. And a lot of people are expanding, and that results into demand for more credit. Correct. When there is demand for more credit, it will push the bond yields higher. Okay. When it pushes the bond yield higher, what happens is that at some point of time, the bonds yield bottoms out and the bond prices peaks out. And once that happens, okay, so what happens is that now the yields are going higher, which means the cost of doing the business is going higher. Okay. So in that case, what happens is that it eventually leads to some sort of slowdown. And because of this slowdown, eventually what happens is that the market peaks. And because then there is this slowdown, eventually what happens is that the demand for the commodities also come down. And that is where we end up being in stage six. Okay. So in stage six, what happens is that bonds are falling, the stocks are falling, and the commodity prices are also falling. So, there is this quick summary of this. So in stage one, what happens is that the bond prices turns up and stocks and commodities are still falling at this point of time. In stage two, stocks turn up Okay, bonds are already rising because it had bottom out in phase in stage one, but at this point of time the commodity prices are still falling. And in stage three, what happens is that everything starts moving higher because commodity makes a bottom in stage three. So then what happens is that the bond prices are rising, the equity market is rising, and the commodity prices are rising. Okay. And this is where what happens is that we come out of the recessionary phase. Okay. And then we start coming into a recovery phase. Basically, this is a recovery phase. Okay. This essentially what happens is that we have hit in recession and then we are trying to recover. So in the recovery, what would happen is that the the demand for the credit, as I mentioned, will start going up, which will push the bond yields higher and which would push the bond prices lower. So in this case, what happens is that the bonds turn down, but at the same time, stocks and commodities are rising. Then in stage fifth, what happens is that at some point of time, the higher yield starts pinching the business people, and this leads to some sort of slowdown. And the slowdown in turn leads to a peak out in the stock market. So this is the point that is in stage fifth. What happens is that the stock prices, start stumbling. The bond prices are already dropping and the commodity prices are still rising because there is a bit of a slowdown. Okay, it is not that everything is falling off the cliff. So that is why the recovery in the commodities is still there. And there comes the sixth and the last stage, where the yields have gone up too much. Okay, and because of which there is no fresh investment or no fresh demand, and because of which it leads to a slowdown in the commodity consumption, and that leads to a turning down of all the three asset class. So now, interesting thing is that, like I mentioned, it is very important to understand where are we in this entire stage. Okay, if you see right now, the bond yields are rising higher, which means the bond prices is lower.
Correct.
Stock market is lower. Okay, we are getting some pullbacks in between, but broadly, if you see the trend, then it is trending lower. And if you see the commodity, it is trending down as well. So we are possibly in this stage six. Okay, wherein everything is coming down. And this also, you can correlate with the Fed, trying to say that the economy has heated up a lot. So we are trying to slow down by increasing the interest rate, which can lead to a slowdown in the demand. Slowdown in the demand will pull the commodity prices lower. So at some point of time, the Fed might tighten too much. Okay, and that will lead to less of a credit offtake, which means the people will borrow less.
Correct.
And that will then start pushing the bond yields lower. And when the bond yields start heading lower, that will be the time when the bond prices will bottom out.
Yes.
Okay. So it is always like that. The bonds bottom out first, the stocks bottom out later, and the commodity bottoms out after the stocks. So just to depict a small I had made a diagram just to save the point. So it looks something like this. So this is bond ka cycle.
Yes.
Okay, the green one is the stock market ka cycle, and the blue one is commodities cycle. So all of them, they make bottom in interval. I mean, there is no specific interval, but first bonds will bottom out, then stocks, and then commodities. That is how generally it happens. Okay, so putting so now, like I said, that understanding which stage are we in was very important. So according to me, probably we are in this stage because everything is right now coming down. So now there is one key development which happened last week, okay, which I want to highlight, and it is extremely important for people to know as well. So wait, I'll just clear all the drawings. So yeah, so in this case, see, this is the 2 and the 10-year spread. What it means is that supposingly, if the 10-year is at 2% yield, okay, and the 2-year is supposingly at 1% yield. So what it will show is the line would be somewhere over here. Okay, because 2 minus 1 is 1. So right now, when this is steepening, that means the yield of the 10-year is way higher than the yield of 2-year. And when it comes to the zero line or below zero line, it means that the yield for 2-year is more than the 10-year.
Got it.
Okay. So now in normal scenarios, you would see that the yield of the higher tenure is lot more than the yield of the lower tenure. Correct? That is because the risk associated with the higher tenure is much more than the lower tenure. When the yields of the lower tenure is much more than the higher tenure, this is something unusual. Okay.
Right.
Because like I said, the risk associated with the higher tenure is lot more than the lower tenure, right? But so what is happening is that whenever the lower tenure rises above the higher tenure, in this case 2-year rises above the 10 years, it leads to inverting of the yield curve. And it is said that whenever the 2 and the 10-year normally inverts, you can expect a recession to kick in probably in 12 to 15 months. Okay. So this I had got it from the US website. So this was this fred.com. So you can see over here, the yields, whenever they have gone below the zero line, okay, this gray shaded area is the recessionary period which has followed. You can see over here the yields had inverted. Eventually, we saw a recessionary phase. Over here again, it came down, and you saw the recessionary phase. Okay, it again came down over here, and eventually you saw a recessionary phase. So this has happened again and again. Okay, so what is happening right now is again, this has gone down below the zero line. So this possibly indicates that we might head into a recession sooner or later. So like I said, 12 to 15 months is the timeline. So to be honest, there is no specific timeline to this. You can just start judging it, roughly by 12 to 15 kind of months. So the interesting part over here is, it is not when you go down below the zero line, that is when the recession starts. It is when again, this starts steepening, which means that the differential between the short term and the long term bond starts, again getting back to the normal. That is, 10-year trading higher than the 2-year. That is when you start getting the recession. Now, what happens is that why 2-year tenure falls? I mean, 2-year treasury yield, why does it fall? Is because now the Fed has probably tightened too much, to an extent that people are probably not interested in buying the debt, because if they buy it, it will cost them more. So the demand for the bond falls. I mean, the demand for the credit falls, and this in turn leads to bond yield cooling off. So what happens is that when bond yield starts cooling off, 2-year ka cool off will be much faster than the 10 years ka cool off, and that is what it will lead to the steepening of the curve. Correct. And when the demand for the credit falls, okay, that's when people are probably not expanding, or the economy is not into that expansionary phase, and that is where eventually we'll end up with a recession. Okay. So this is on 2 and 10 year, but the most immediate, okay, I mean 2 and 10 year, like I said, the spread is between 12. I mean the fall occurs after 12 to 15 months, right? But if you see for 3 and 10 year, okay, it actually happens sooner than the 2 and 10 year. So in this one, it is 10 year and 3 months. Okay, 10 year and 3 months. So what happens is that when 10 and 3 months, 10 years and 3 months invert, so then, you can expect it to, a recessionary phase to kick in within 6 to 12 months.
Got it.
Okay. So what has happened is that, see, in the past as well, you can see over here, then you saw. So again, the concept is same. It inverts, and after a few months, you get a recessionary phase. Okay. So now this I have tried to put in the context with the chart prices. I mean, with the indices prices. So to understand when it inverted and when the recession actually started. Okay. So now in this, you can see that this is 10-year by 2-year ka spread. Okay. So this had inverted, and you can see that for few months, it just went sideways. And only after that, you saw this correction.
Correct.
Okay. You can see in this phase. See, it inverted over here, it consolidated, and then it fell.
Yeah.
Similarly, around this point, it inverted, the index kept moving higher over here. And after few months, it corrected. Similar was the case over here. It inverted, it went higher, and then it corrected. See, usually what happens is that when this inverts, okay, when, like I said, when does it invert? Because 2-year ka yields is higher than 10-year. That means that the demand for credit is very high, which means that the economy is already very hot. When the economy is very hot, that time the stock market will do well. And that is why you would see that whenever it inverts, so after for few months, the markets keep rising. Correct? It is only probably for this time when it has inverted and the market has kept falling. I mean, this is a little weird.
Yeah.
Frankly, you would expect an inverted yield curve over here, and you would expect the market to rise for a while, and then it will collapse, or then it will see a bigger correction. Like you saw over here, it inverted, and then you saw a sideways, sort of trend for many months. But in this case, it is already falling. Now, I'll show you the interesting part. The 2 and the 10-year had inverted at the start of 2022.
Correct.
Right? Now, if you see the 3 and the 3 and 10 month. So, while I was doing this a few days back, so at that time it had not inverted yet, but now it has inverted. I mean, as we speak, I think the inversion is by 0.03. So, wherein the 3-month yield, is 0.03% higher than the yield of 10-year. So now you can see over here that if you notice, okay, in pick 1, the yield curve, 2 and 10-year had inverted at this point of time.
Correct.
Okay. But if you see in 3 and 10, 3-month and 10-year, it has inverted over here. So what it does is कि वो जब भी crash होने वाला रहता है उसके और थोड़ा near आके it signals. Over here as well, if you notice, it was around this point. Okay, but 3-month and 10-year has given an inversion around this point.
Yeah.
Okay, so now what is happening is that even for Dow Jones, it has only now that it has inverted. Okay, so then if you go by this thing, if you go by the studies, and the best part is that in the past it has given 4 or 5 times this inversion, and all the time it has been followed by recession. So if you see the strike rate of this particular thing, then it is very you cannot ignore it. So every time what happens is that whenever the yield curve inverts, people tell that this time it's different, we won't see a crash and all of that. But time and again we have seen that whenever people start saying that it is different this time, actually the history repeats.
Correct.
And it is never different. So this is what the setup on the 3-month and the 10-year is indicating. Okay, so this means that there can be some bit of trouble in the coming weeks or months ahead for us.
Correct.
So yeah, so this was the small presentation on business cycle and the yield curve inversion, which I wanted to tell people and show them the importance of this yield curve.
Got makes sense. We ended with talking about Dow Jones, so I will just quickly move to the next question. We saw Dow Jones seeing a pullback. What are your thoughts on that?
Yeah, so I'll just open the charts of Dow Jones. So if you see last time, somewhere around this point,
Yes.
okay, we had said that probably we might get a pullback.
Yes.
Okay. So that and followed the next day was the inflation data, wherein Dow Jones indices, it opened with a cut of around 600 point, and by the day end it ended higher by 800 points. Such was the volatility, and since then it has been moving higher. The reason for anticipating a pullback was because if you see the weekly chart, okay, over here it is actually not reflecting, but there was a 5-wave decline. So basically on the daily chart, if you see, this was the 5-wave decline, okay, and over here the sentiment was getting extreme as well. So at some point of time when the 5-wave decline was going to end, you were going to see a good pullback, okay. So in terms of pullback, like we had mentioned yesterday, last time as well, that we would first expect the 38.2% retracement to kick in. Once that is surpassed, we will go level by level for each of the retracement, okay. So if you see right now, so Dow Jones has surpassed the 50% retracement mark, okay, which leads to a little more upside towards the 61.8% retracement mark, which is around the 32,156 levels. Okay. And right now it is at 31,837. So yeah. So yeah, like, you can see some 300, 400 points upside more in the near term. But I'll tell you the interesting part. The interesting part is if you see S&P 500, okay, it has not, I think, even surpassed the 50% retracement mark. So yesterday it has just surpassed the 38.2% retracement level. And the most interesting thing is that Nasdaq 100 has not even done that. I mean, Nasdaq index has barely, I think, retraced 38.2 of the entire fall. You can see over here, it has just come over here at the 38.2% retracement mark. So what does it mean is that there is a chance that the pullback can overshoot a bit in Dow Jones indices. That is because the Nasdaq 100 and the S&P 500 hasn't, seen that much of a, pullback. So this is one thing, that can happen in the near term, which we have to take care. But I think once this pullback is complete, there is, as of now, we are of the view that once this pullback is over at this point or at this point, at whatever point it ends, we are again going to see the next leg of down move. That is because in the overall context, this is just one of C. What right now is happening is probably 2 of C. And once that is complete, 3 of C will start, which will push the Nasdaq and all the US indices much lower than this low.
Correct.
So this is what our working view is right now. And, we sort of expect that once this pullback is complete, we are going to see the next leg of correction unfolding.
Correct. So this is how this market has been reacting. Talking about our own Nifty index, that also witnessed a pullback. What are your thoughts on our own market?
Yeah. So in Nifty index is frankly a little more complicated. That is because the Nifty index has retraced more than 61.8%. In fact, it has done almost 78.6% retracement. So if you wait, I'll just remove the colors in the background. So you can see over here that this is the 78.6% retracement mark. So now the question is that whether it will surpass this high and it will form some kind of distribution pattern of this sort. Okay, wherein we move higher towards this level, which is 18,200 or so. Is that possible? Looking at the Dow Jones indices, you cannot rule it out basically.
Yeah.
So, whether the pullback in the Nifty index ends over here, I mean, at the previous high, or it goes above the previous high and it moves towards the higher trend line, or it falters over here and it starts falling down, is something we need to see. Okay, the only trigger possibly I can think of which can lead Nifty index higher towards this 18,200 level is that the FII's positioning. So the FII's positioning as of Morat Day, I have not updated the data today, but as of Morat Day, they are still short by 60,000 contracts. Okay, so that in our view can come down to zero, because whenever we have seen in the past that whenever they have shorted to an extreme, so this time at this point of time, okay, around this lows, the FI net short position had gone up to 1,30,000, 1,40,000 contracts, and these are extremes. And whenever we see extreme readings, we have seen that post that they usually come back to the zero mark, wherein they become neutral, and then they start viewing the market and they form the position accordingly. So our view is that maybe we can see FII's, short position coming back to the 0 point. So that can be a trigger, at least in the near term, which can push the Nifty index higher towards, probably this 18,200, 300 sort of mark. But that is the best case scenario which we are looking at. The other thing is that we follow Dow Jones, okay, and we probably move marginally higher, and we may not break the high. So how far, basically the pullback in Nifty goes is something we are watching out very carefully.
Yeah.
But the advice to the people, who are probably long, because right over here, we had said that we are anticipating a pullback in the Nifty index as well. Because what had happened was that in Nifty index, it made a higher low, while the Dow Jones had made a lower low. So there was an intermarket divergence over there. So we would keenly watch out for the intermarket divergence. And once we see that, we'll again warn, and we'll again, try to be very decisive in our commentary as to what we feel. But as of now, there looks like there might be some more room left on the upside.
Correct. Makes sense. Yeah, the market has been taking interesting turns, the foreign markets as well as our own Indian markets. So it's very interesting to watch where everything is going. It's like a hodgepodge, basically. But yeah, there are a lot of things happening. Also, thank you so much for explaining to us the theory that you did of Martin Pring. It was informative, and we can apply and relate stages to real market phases that we are going through. And it does help in understanding how it is. We can relate a lot of things to those.
It has actually worked well for me because, you then need to, you then know then where should you position yourself in bonds, in commodities, or in stock. So it has helped me a lot. So I thought that it might be useful to share it with people.
Definitely. Thank you so much for this session. It has been really, really helpful. And I will see you next week.
Sure. Welcome.